Hello, everyone, and welcome back to the GMS Weekly Podcast, where we break down the key developments shaping the global ship recycling markets.
It's week 27 of 2026, and this week's story is clear. Fleet exits, dollar enters.
Exactly. The war is over. The Gulf fleet is finally moving. But the dollar has now become the new pressure point for the subcontinent.
Let's start with the Gulf. What has changed on the water?
Crude flows through Hormuz have now crossed 10 million barrels per day under U.S. military coordination. Lloyd's List also counts roughly 550 merchant vessels preparing to exit the Gulf, including around 200 bulk carriers.
So the exit queue is no longer theoretical.
Correct. The Central Channel is still constrained by an estimated 80 mines, so traffic is using the northern and southern routes for now. But the important point is that vessels are moving again.
And that matters for recycling because many older vessels were held back during the war.
Exactly. The war kept candidates trading. Now that the Gulf is reopening and oil has fallen back, those reasons are weakening.
Brent is near $71 now, right?
Yes, Brent is effectively back at its pre-war level after touching more than $126 in April. It has closed the quarter with its sharpest fall since 2020.
That is a major reset.
It is. And the interesting part is that U.S. crude inventories have still drawn for 12 straight weeks, so the inventory shortage remains, but the price is choosing to focus on the reopening.
What about freight?
Freight has adjusted, but it has not collapsed. The Baltic Dry Index bounced late to around 2650 on iron ore strength, and Capesize earnings are still near $32,000 per day.
So the war premium is fading, but the market is not falling apart.
Exactly. The index gained 25% for the quarter, but lost 22% for the month. That tells you the conflict's freight premium outlived the war, but it is now clearly fading.
Which brings us back to recycling.
Yes, two queues are now forming. One is the visible line of vessels exiting the Gulf. The other is the deferred recycling wave that the war held offshore.
But the monsoon is still holding the beaches.
Correct. The ships are moving, but the beaches are waiting. That is the tension this week.
Let's move into the destinations, starting with Bangladesh.
Bangladesh remains at the top of the rankings, but the taka has finally moved through its long-held band. It traded toward 123.2 to 123.3 against the dollar.
The band survived the war but broke in peace.
To the dollar, not to Hormuz, the pressure is coming from the broader dollar strength, with U.S. inflation at 4.2% and markets pricing a possible Fed rate hike by September.
What about Chattogram?
The setup still looks strong. Steel eased from 67,000 to 66,000 taka per ton, but demand, financing, and plot capacity remain available. The port list also shows activity, with large gas units such as Zamrud and ERG delivered during the window.
So Bangladesh still has the strongest second-half setup?
Yes, the taka move is a pressure point, but the broader structure remains strong. The wave is no longer just an idea. It is now a visible list.
India next.
India's rupee gave back part of its recovery, moving near 95.1 to 95.2 against the dollar. Brent near 71 should have supported the rupee, but the stronger dollar has taken control.
So the oil benefit is there, but the Fed story is stronger.
Exactly. India's fundamentals are improving, especially with lower oil, but the currency is now waiting on Washington's inflation problem.
And along?
Aliaga steel softened to around 36,700 rupees per ton, or about $385 per ton. India remains the lowest-priced subcontinent destination.
But it still has the compliance advantage.
Yes, with more than 110 valid statements of compliance, Aliaga remains strongly positioned for post-monsoon routing. The issue is price. India leads on compliance, but remains the basin's floor on offers.
Pakistan seems to have a different story this week.
Very different. The Pakistani rupee strengthened below 278 and June CPI eased to 11.1%. Consumer prices even fell 0.3% on the month.
So the oil collapse is finally showing up in inflation.
Correct. But Pakistan also has a new variable. The July 1st SROs have reduced duties on scrap and prime steel products, which could put pressure on local recycled and re-rolled material.
So Gadani gets a macro benefit but faces policy pressure.
Exactly. The currency is strong, inflation is cooling, and steel is still near 195,000 rupees per ton. But the duty changes may test how much Gadani can hold on pricing.
And Turkey?
Turkey remains in its own lane. The lira moved toward 46.7 against the dollar, another record low. The June inflation print is the next key watch, especially with oil now much lower.
Does cheaper oil help Turkey?
It helps, but only at the margin. Inflation is still structurally high, and Aliaga remains far below the subcontinent on price, around $266 to $288 per LDT across vessel types.
So Turkey remains a regulated niche market.
Exactly. EU regulation and Basel-linked business still define Aliaga more than mainstream price competition.
Let's wrap it up.
Week 27 is about movement and pressure. The fleet is exiting the Gulf, oil has settled back near pre-war levels, and the deferred recycling wave is becoming visible.
But the beaches are still governed by weather.
Yes, the monsoon decides when the wave can land.
Bangladesh has demand and financing, but the taka has moved.
India has compliance and capacity, but remains the lowest-priced market.
Pakistan has stronger currency and lower inflation, but new duty pressure.
And Turkey remains a niche market with the lira near another record low.
Fleet exits.
Oil settles.
CPI turns.
Dollar enters.
That is the story of Week 27.
For the complete market picture, read the full GMS Weekly.
Thanks for listening.
We'll be back next week with more insights from the global ship recycling markets.